You want to buy a home in your 20s? Fantastic. But before you sign anything, I've got 5 tips that you need to know before you get started. I'm David Zai, mortgage guy. I've been a mortgage loan officer for over 17 years, working to get people just like you from renting to home ownership. So, you're in your 20s, buying a home can definitely seem like an impossible goal, especially nowadays. While my channel is dedicated to showing people how to make home buying possible and escape the rent trap on practically any income, it's important to remember that not all houses are built the same. The most common issue I see working with people in their 20s or first-time home buyers in general is that because you guys are inexperienced, there are sellers and realtors that are quick to try to take advantage of you and unload unwanted, unprofitable properties with the promise of later returns that just aren't coming. Buying based on emotions or impulse can kill your budget, but it can also ruin all the hard work that you put into saving up for that down payment by destroying your ability to achieve a good return on investment on the home, or just become too costly if, say, an accident were to happen. Tip number 1, follow your numbers, not your heart. I would actually suggest, instead of searching for your realtor first, start by searching for a loan officer like me. Typically, your loan officer isn't the first person you think of calling when buying a home, but an experienced loan officer can actually help you set up a budget that is almost guaranteed to get you pre-approved for a loan. Now, why is a pre-approval important, you may ask? Well, it's because the loan officer needs time to review your entire loan application and actually look for things that will and won't work based on guidelines. We'll also need to review all of your income, assets, and liability documents, which actually consist of pay stubs, tax returns, W-2, 1099, and assets that include your bank, stocks, bonds, mutual funds, and retirement plans, and finally your liabilities that are actually not reported on the credit report, such as alimony, maintenance, childcare, and child support. Even though securing that pre-approval is important, it is actually an insight into what you qualify for, not what you can afford. Getting approved for a $250,000 loan can be a surreal experience, but before you go flexing a bag you don't have, let's talk about where this money goes, how to manage this money responsibly, and actually how much money you're still going to need apart from the loan amount. Tip 2, don't overestimate your budget. Let's see what happens when we try to buy a home that's closer to the total of the pre-approval amount. For this, we're actually going to use an FHA loan. FHA loans are actually designed for not only first-time home buyers, but affordable option for people with all different types of credit scores and have lower qualification requirements that most of you will probably need. You come to me with a home that costs $225,000. Before I look at anything, I'm going to ask you one question. What is your down payment? On that FHA loan, the lowest amount we can put down is 3.5% with a 620 credit score. That means on a $225,000 home, you're going to need at least $8,000 down payment. That's not from the loan, that's from you. All of a sudden, this $225,000 home that we could get a loan approved to buy is just now out of reach for most of you. In a minute, I'm going to give you some tips on how you can make this down payment affordable. Let's try something more reasonable for our first time home. So let's pick a nice property for $150,000. It's not as big or as modern, but it's sturdy. And to make things a little easier, well, let's just say that there are no major repairs on the horizon. Now, that 3.5% down payment is just over $5,000, which is going to save you a lot of time and obviously money. Once we get the down payment out of the way, there are a lot of added fees. No one likes these, but they're very important. Some lenders or brokers might add on what we call junk fees. These fees are ultimately unnecessary and added in to increase the origination. These fees could have different names, but have absolutely no relevance to completing the loan. If you see these on your loan estimate, run. First fee we want to talk about is application fee. Then there's administration fee, doc prep fee, rate lock fee, and any separate inspection fees that are not related to the appraisal. Real fees that you can't avoid include your credit report, appraisal fee, funding fee, filing fees, because all of these costs are going to be represented in your loan estimate document, which you have to receive 3 days from the loan application. And this will actually give you an estimate of cost associated with facilitating the loan and the actual purchase of the property. But for me, this is far from the most important cost. The most important cost when determining the affordability of a home is the monthly payment. This is what will make or break your home buying journey. On my website, I have a monthly payment calculator that will help us assess these costs. And my website is davidzimortgageguide.com. On the website, you can use the calculators to calculate our estimate, and this is what our average monthly payment should be on our $150,000 home. Compare this to your rent and the fact that every month you pay that, you're funding investment portfolios of Wall Street bankers, private investment firms, and landlords instead of your own future and financial freedom. Hopefully, now you understand that despite the importance of getting pre-approved, you can let the big numbers distract you from the actual true costs. If you don't keep up with this, you can actually end up in foreclosure. Don't panic. This doesn't happen until you're at least 5 months behind, but honestly, you don't even want to get 1 month behind. Late mortgage payments can ruin your credit faster than just about anything else. From there, it's a slippery slope. This is why assessing not just your monthly mortgage payment, but your average monthly expenses is so vital to your success. So be smart, subscribe to my channel, and after watching this video, go down to the description and click on the game planning and budgeting playlist down below to help you get prepared for taking on the cost of ownership. There's a lot of information and good stuff down there, so check it out. It is really important to note that a foreclosure will actually stay on your records for 7 years, and you will have problems with additional home financing for at least 3 years after a foreclosure is recorded. It's really important. Don't overestimate your budget. Tip number 3, do your research. Like I said earlier, I've been a mortgage loan officer for over 17 years, and even to this day, I still find new ways to help people secure loans. The only way I or my team can do this successfully is by studying guidelines constantly. Luckily, you have a lot less work to do. On my channel, I have detailed guides on each of the 4 major loan options and how to use them in nearly every situation. While 4 options might not seem like a lot, within these loans are different loan products and programs that can drastically change your loan outcome. It's important to go over these options with a seasoned loan officer, but it's important to know this information for yourself so you know what to look out for. But for now, let's focus on 3 kinds of mortgages, regardless of the loan type: fixed rate, adjustable rate, and reverse mortgages. What is a fixed mortgage? Fixed mortgage is basically a fixed mortgage over the term of the loan, whether it be 15, 20, or 30 years. Adjustable rates actually adjust once you get to a certain point, and that's typically 3, 5, or 10 years. And once those terms have matured, then it can adjust. You know what? Just don't do an ARM. As of this recording, the risk involved in getting an ARM is not that big of a difference in the upfront rate and locks you into an adjustable rate mortgage, which gives you less certainty when it comes to budgeting. And finally, reverse mortgages. If you got any older family members over the ages of 59 and a half and they have a large sum of money to put down, or just want to refinance with a lot of equity, this is actually a great option. You're going to have no monthly mortgage payment. You may be able to get some cash out, but the balance actually gets higher every month. Ideally, the equity goes up as well as keeps up with the rising principal balance, so it is a bit of a gamble, but it's definitely worth looking into depending on where you live. Differences like these are why it's so important to talk to a loan officer you can trust, and just as important, a loan officer who can give you options. Recently, I helped a customer with a refinance. He got qualified with a retail lender, which he didn't know at that time, and he picked the first realtor that he could get. Long story short, while going through the process, he discovered that there were lower rates, but by that time, he was already 10 days away from closing, and he couldn't really extend the closing date. His realtor that he picked wasn't really experienced. They weren't really able to help him when there were issues that came up and really do a good job in terms of negotiating. And then finally, he gets the closing and he finds out that he could have gotten way better options. He could have saved a lot of money, but luckily for him, he was able to refinance. He saved $200 a month without sacrificing any of his comfort. I was able to do this not just because I'm an experienced loan officer, but because I actually work in the wholesale lender space. The difference in going to a retail place is that, yes, you may have heard of their name, you go into their beautiful buildings and everything. However, there's higher margins for that advertising and everything else that comes with it. Whereas when you go with a wholesale lender, we have no extravagant buildings. We go directly to the actual wholesale lender itself and we do the loan there, we get the loan underwritten, and because of that, there's a lot more flexibility. Certain lenders are gonna have overlays, certain lenders are gonna have no overlays, and we try to go to the one that gives us the path of least resistance. And based on 2021 HMDA data, when you go wholesale, you will not not only have more options, better speed, but you will save, and on average, between $9,400 and up to $10,400 for minorities over the life of the loan when going wholesale over retail. Tip 4, plan for tomorrow and the next day. When you're buying your first home, it's important to remember that it might not be your dream home. That doesn't mean you shouldn't buy whatever house you can afford easiest. Remember that this is an investment. Even if you don't intend to stay in the home for the next 10 years, it's important to buy like you are. Consider your location down to the neighborhood and research the housing trends, schools, and any future development plans for it. If you don't take these into consideration, you'll end up having difficulty selling, and if you're lucky enough to sell, you risk selling at a loss. Not to mention, if you intend to use the home as an investment property, you might have trouble finding a good tenant if you get them to move in at all. So we're gonna talk about this more in the budgeting video, which is gonna be linked down below, but remember to factor in other costs like property taxes, insurance, and of course, utilities. Plan for things to go wrong. Failing to keep up with routine maintenance can lead to catastrophic outcomes if things begin to fail. I budget 17 cents per square foot. This is the VA requirement and a solid estimate to keep you protected. Now, pro tip here. If your home inspection comes back clean, you might explore setting up a major repair maintenance fund and investing that into an interest-bearing account, helping your maintenance costs take care of themselves and have money grow. Don't get carried away with this though. Penalties can be incurred for withdrawing too much or too early. Make sure you still have some liquid funds in case of minor emergencies. And finally, tip 5, failing to plan for the long term. So we always have to assess for long term, and things such as career, family, and lifestyle should go into your decision making when choosing a home. Always choose a home that's going to accommodate your future needs. If it doesn't meet your future needs, plan on becoming a landlord and have that action plan in place for long-term or short-term rentals. Homeownership is a true financial freedom, not a get-rich scheme or an internet scam. Some things that you really need to look out for is needing to move prematurely, okay? Don't act on emotion. Outgrowing that home quickly. Yes, it may be super awesome to buy that affordable home just like I did. It was a small 750 square foot home, but as soon as we had an extra body, which was my first child, I knew we had to move. And then also think about where you'll be in 5 to 10 years and choose accordingly. If you found these tips helpful and want to learn more about home buying in your 20s, head over to my channel or click on the link in the description where you'll find a playlist that will break it all down for you and prepare you to make informed decisions about your home purchase. There's a lot to know when buying a house, and there's a lot of people out there giving information, so thank you for sticking around and hearing me out. Remember, I'm a loan officer. That means I'm in the trenches with these loan programs. I'm getting information directly from the organizations that realtors don't necessarily have access to. Knowledge is power, and making informed decisions will help you avoid disaster. Don't forget to like, subscribe, and hit the bell icon for more. Thank you for watching. I'm David Zai, Mortgage Guy, and I'll see you next time.